So Japan struggled in an auction for its longest dated bonds today, and across the market for government bonds around the world, there are worries about big government deficits. We have seen long-term bond yields move up, and that indicates that investors have been avoiding long-term government debt. Let's get more from Konstantin Boehmer, who is head of fixed income and portfolio manager at Mackenzie Investments. Great to see you.
Great to see you again.
Start off with Japan. Are people, I mean, Japan's had massive deficits and debt for decades, but a lot of its debt is held domestically. But are people worried about the Japanese fiscal situation?
Yeah, not so much as people are about the US, but I think there's a different situation at play in Japan. And you're also correct, it is primarily domestically held, but also a large chunk is not owned by the pension funds or individuals in Japan. A lot is also held by the Bank of Japan, so that is kind of the QE version. And they have been kind of the number one in the world who has pushed the QE theme to the extreme. And with, I believe, the negotiation that is happening between Japan and the US, and also that sense of the Japanese yen being too weak in those conversations, having more power on the QE side by the Bank of Japan is fading away, and that is letting the long end of the curve rise a little bit more than what we are used to. So that is creating a scenario which is not good for the bond market, because the Bank of Japan cannot support probably that bond market as much as it has done in the past, because if they were to support the bond market, the currency would weaken, which will create a difficult situation probably in those conversations with the U.S. Trade, or in the U.S. trade negotiations.
Oh, okay. Because, I mean, critics of the policy of a central bank buying government bonds say it's akin to printing money.
That's right. Yes, and you would see that in the currency, right? So the currency is usually the transmission mechanism that shows how sustainable your policies are. And we've seen the Japanese yen being exceptionally weak over the past few years, and in pretty much all metrics looks vastly undervalued in the global scheme. So it is a hugely undervalued currency. But their bond market is actually looking pretty good. Like, bond yields are still all across the curve pretty low. They've had that yield curve control for such a long period of time, where they controlled all the yields up until 10 years. And then the back end of the curve was led to more market forces, but clearly also influenced by central bank buying. And that contained the yield levels in Japan quite significantly.
But as their trade talks with the US move forward, America might be inclined to say, well, you're letting your currency drop, and that's a competitive devaluation.
Exactly. So it is letting your currency drop is a competitive advantage, and maybe even also having your bond yields at, let's say, non-market clearing prices could also be part of that negotiation, because Japanese companies can borrow money at much cheaper rates than US companies can borrow in the US.
Talk to us about the US bond yields. Maybe we'll put up a 10-year chart for the US 10-year bond yield. I mean, we've heard talk about US deficits for years and political complacency about the growing debt, but we seem to be hearing more and more of that this year.
Yeah. And I think there's we've seen a shift probably in the last few months, where the initial, let's say, impetus of the US administration was a lot also looking at deficits. We had Doge coming in, and there were a good amount of optimism around that also in the administration that has seemed to have faded to some extent. And probably also on the tariff side, there was a lot of attention on the tariff side, and that has moved now towards the big, beautiful bill. And that is now talking a lot more about maybe it is not the expenditure side that is being addressed. And now we're starting to look again at the raising expenditures and starting to really trying to pump up and goose up the US economy through those bills. And that is something that the market doesn't really like. And probably that shift from maybe some more fiscal conservatism, which was maybe an inkling that the market has gotten at the beginning of the Trump administration, has shifted now back towards the belief that fiscal is going to be a central part also of this US administration, and it will not be any different from the past.
Would you be a buyer of U.S. 10-year bonds right now, Konstantin, or would you be inclined to overweight them?
It always depends on the time horizon you give me.
Yes, I know, of course.
That is the easy out on this, but I think short term it probably doesn't look bad. We have month end coming up, so there's a little bit maybe extra buying coming here. You also have those big asset allocation flows that happens when you had a pretty bad month. There's oftentimes that reallocation from asset managers that are happening, so that would indicate maybe more fixed income buying, but that is all very short term. The medium term story is still pretty poor, so that is U.S. economy is not really at the risk of slipping into recession. Yes, there's still a lot of uncertainty around it, but the real fear of slipping into recession has faded. And that is also probably supporting inflation at slightly higher levels and growth at slightly higher levels. And now you have fiscal, so doesn't look good, but valuation is starting to look interesting again.
What about Canadian bonds? I'm not sure how much time you spend on those. Maybe you can put up the Canadian 10-year yield. Well, of course you do, yeah. Are Canadian 10-year bonds attracting you right now?
Probably less so than the US. So I have a greater sympathy for US because valuations look better. And in the US, valuations are, like I look at TIPS, so that's inflation-linked bonds. And when you look at the real yield, so this is the yield you get, plus you get inflation, that is 2.1% in the 10-year, 2.7% in the 30-year. So that is pretty good for anyone who wants to preserve purchasing power in the future. For Canada, I think the risk is that we don't know how the budgets will look like. Mm-hmm. And the risk is that we're moving more towards the European model. And looking at Germany, we've seen that gigantic package on military and infrastructure spending. So I think the risk is that we will see a little bit more of that also coming from Canada, maybe not as extreme, but that would keep me a little bit cautious on Canadian bonds.
So if deficits balloon, or that's going to discourage people from owning government debt?
Yes. And then specifically, right, it is all a global competition. Mm-hmm. Right? You have, we're looking at all the countries around the globe, and the ones that are spending a little bit more aggressive than others and maybe are not having the greatest starting point will get hurt the hardest. UK was in that position for a fair amount of time in last year and the year before, where all the attention was on the UK government and on their fiscal spending. Mm-hmm. That has shifted a little bit to Europe, and maybe we'll see what happens in Canada, but that is where I'm paying attention to.
Konstantin, thank you very much.
Pleasure.
Konstantin Boehmer, Head of Fixed Income and Portfolio Manager at Mackenzie Investments. Let's have another quick